the closing beat, everybody. Happy Monday. How's it going out there? I'm going to need just a second here to get organized because this was kind of thrown together at the last second here with these buttons. You know, you had nothing to do this weekend. You start playing around with this stuff and then you mess up everything. There we go. How we doing? Welcome to the Closing Beats, a quick show that we do to cover the stock market, do all the good stuff there. Yeah, that's basically all I have. We're financial advisors here at Jazz Wealth, although it doesn't seem like we're very well put together today. I got a good show for you. I got a lot of good stuff in here. I had a little extra time, so we're going to share some of this stuff. And I know you guys like the different things. You know, you can watch CNBC or Bloomberg or whatever and get sort of that stuff. Not that it's bad, but we try to do things a little bit differently here. And so one of the things we do is we teach classes for our customers. Every Thursday we do a class. Maybe working on something where we can get other people involved as well. If you can't be a client of ours, but you still want info, still want something with the good stuff there, maybe working on something, can't say. Old Charlie still working on it, taking his time. Anyways, here we go. So let's get started here. Thursday night class this week. We're going to go over the stock markets. We're going to go over portfolios. We're going to go over lots of studies and things that we're doing here, just kind of share what's going on with the overall stock market. We're playing a game. It's called Guess the Dow, bottom right-hand corner of your page. If you want to take a shot, you can take a shot. No strings attached. In our Jazz Artist of the Week, we're going with Charlie Parker this week. Mr. Saxophone, Charlie Bird Parker is known as Yardbird, and so the song today we're going to start with is the Yardbird Suite. So if you're looking for something a little bit jazzy to listen to tonight, there you go. Let's talk about the stock market today. 26 on the Dow, 12 on the S&P, and 105 on the NASDAQ to the upside. Had you not watched until the later part of the day, you would have just assumed it was going to be a down day. The stock market was actually lower most of the day and over the evening last night with futures open. S&P is back into the chop zone here. We've highlighted with this little line that we keep putting on the screen there so you can see. Sort of indecision area. A little above, a little below, a little above. Markets aren't really decided what they want to do from here, which makes perfect sense. We've recovered about half of the decline from the virus decline. You could see it. It's plain as day there. Recovered about half of it, but the markets are like, I don't know if we have any good enough news to keep us going. Earnings weren't so bad. We'll cover that in a second. But also, we don't know if should we head towards the lows or things really that bad. So we have this indecision point right at the halfway mark there. Think of it as a glass half full or half empty. We could argue all day whether it's half full or half empty, and that's what the markets are doing. The strongest index out of the group today was the NASDAQ by far, thanks to your FANG stocks. I'll cover a little bit more of that a little bit later. And the weakest on the day was the Russell 2000, but I threw the Dow in there as well because they were very close. The Dow was down just a little bit on the day, as well as the Russell, but the Russell's coming off of its 5th best month ever on record. I shared that with you last week if you're interested in that. I mentioned earnings a second ago. We're in the middle of earnings season here, and I got some stats for you. Since April 13th, when we say this whole thing kicked off here, 62% of companies have reported better than expected on earnings, 64% better than expected on revenue. It's a little bit above average right now. So this earnings season is basically not as bad as everybody was expecting it to be, and now they're trying to throw the focus into next quarter as well. Now, guidance is a little bit tough to come by here because companies aren't reporting as much guidance, but we've got some data for you. This is the guidance ratio. We're going to get a little geeky. I just, skip forward if this is not your thing. But the guidance ratio basically just means give me the ratio between the companies raising guidance and lowering guidance. And right now, the average is about 2.97, but more companies are lowering guidance to the tune of 12 times more companies lowering guidance than they are raising guidance. Here's a little bit deeper. If you look over I went back as far as I could to see if this was any sort of record or anything. It seems scary when you look back here and you just look over the last year, but if we look out all time, as far as we can go, you see it's really not that bad, companies lowering guidance. However, the number is misleading, so if you ever see anything where somebody says, oh man, nobody really lowered guidance, so it must have been a good quarter, the problem was they're not giving guidance. Remember, a lot of companies are just full out withdrawing their guidance there, and so that number may be just a little bit skewed. So let's take it a step further. Earnings season. You got just over a 6-week window through the bulk of earnings season, and we plotted the performance for you. So what we did is we took the average performance of every single day throughout earnings season, throughout the entire 6-week period to show you, is there a better part of earnings season? Is there a scary part? Is it always good? What's happened? So we went back to 2009, and here you go. We broke down the earnings season by week. You can see the charts plotted there, and very easily you can tell that the first 3 weeks of earnings season since 2009, that's the exciting point there. That's where you get your banks, your big name stocks, your big tech stocks, and everything like that. They all report in the first 3 weeks. So you can see the average move for the stock market there is just over 1.5% if we look over since 2009. That's the good news. The bad news is we're not in the first 3 weeks. The first 3 weeks is now over. We're headed into the back half of earnings season, where performance tends to be a little bit sloppy in terms of the overall stock market. By the way, we're trending almost perfectly right now relative to history. So if you take this and you say that's basically the average of the since 2009, we're actually trending perfectly right now. So if that continues, you'd expect a choppy market going forward. Just wanted to kind of show that there. The back half of earnings season always tends to be a little bit sloppy there, and in fact, it's a little bit negative if you look to 2009 overall there. All right. Well, here we go. Let's take a look. There we go. There's the markets there. We're through earnings season there. Now, I want to point out something here with a couple different stocks. You got Amazon, Apple, Alphabet, Apple, Facebook, and Microsoft. They make up about 20% of the S&P 500. And Goldman Sachs says, that's not good. These things are not doing well for the overall market. Up 434%, 137%, 159, 271, lots of percentages over the last 5 years, just with those 5 stocks that are currently 20% of the overall stock market. That's not a good sign there. And so if we just go take a look, here's what Goldman Sachs is saying. When there's only a handful of stocks that lead the markets higher, when they take a break, the stock market tends to have very nasty declines to the downside. Right now, we have these 5 stocks, which make up 20.37% of the S&P. What you're seeing on the screen is all of the holdings of the S&P 500 relative to their weight. I started sharing this with you a couple weeks ago. And then the most heavily weighted in the S&P 500 right now is Microsoft, 5.65, Apple, 5.08, Amazon, etc. You got your trillion-dollar companies in there. Well, all of those make up 20.37%. All of those happen to be doing the biggest lifting in terms of the overall stock market. So Goldman Sachs is under the assumption that if we pull back, it's going to be a rather nasty and quick pullback there. So maybe something to check out if you're interested in that, or maybe we could follow up with it as we go. Our FinTips video today at 1 o'clock was scanning for Wall Street's favorite stocks. I'm going to do more of those as it's maybe it makes sense, or if you guys like that, kind of show you how to zoom in and find a bunch of different stocks that, well, Wall Street seems to like. So maybe you'll like them as well. And on our Outside the Virus show earlier today, we covered all of the earnings stats, really kind of cool, earnings stats for all the companies reporting tomorrow, Disney being one of them. Yay. So there you have it. Let's go over to the sector breakdown today, and we'll start with the right symbol. We'll look at tech. Tech led the way today. FANG stocks did the heavy lifting. That did its part. Now, half of the technology sector's returns, and this is not good for me, half of the technology sector's returns today came from Microsoft, up 2.45%. So if you look at the tech sector there, you go, okay, 1.3% was the gain. About 0.75% of all of the gains in the tech sector came from just that one stock having a good day there today. I got another way you can look at it here if we just zoom in a little bit further. Here is the technology sector, and I broke it down in the same way. Just try to get used to you seeing the same sort of charts there. Microsoft is the biggest position, not only in the S&P, but it's also the biggest position in the tech sector at the moment, making up about 22%. Well, you can see today, contribution to the gains today was just under half, and man, it's just one of those days. Microsoft did really well there, making up that part of the tech sector. So from the start, we had the tech sector doing really, really well. And so you go, okay, great. Tech is helping us out. The markets were still down. Well, you go look at financials. Financials didn't participate today, basically down about 1%. What's the reason for that? If you really want to know, financials, you have Berkshire Hathaway. Anyone's fine. Berkshire Hathaway down 2.5% on the day because of the Warren Buffett meeting, the shareholder meeting over the weekend there, where Mr. Warren Buffett didn't seem too happy about what was going on there. And the Berkshire Hathaway makes up 15% of the financials. So when that's the biggest holding, by the way. When the financials have a bad day, or Berkshire Hathaway has a bad day, you can imagine the financials are going to be held back there a little bit. Add in the healthcare as well, which was basically flat by the end of the day, and you have a recipe for a stock market that had a hard time going higher today. In fact, if it weren't for that last rally in the afternoon there, which I think I have as well, oh man, I got all kinds of stuff for you today, then you wouldn't have the market higher at all. So to start the day, this is the beginning of the day here. For the day, we had financials lower, at least a lot lower. And you can see the light green line there, not the dark green, but this light green line, that's your tech sector. So that one was basically helping hold everything up on the day. Energy did its thing. But overall, you had everything else pretty much flat, just a small down day. Well, I highlighted the area here. Once you get into the afternoon, everybody came back from lunch, and every sector started to gain just a little bit. Well, that helped kind of move the markets back higher today, just sort of a broad-based, almost index-type buying into the close, or I wouldn't say, in the afternoon, I should say. So anytime you see every sector moving up in about the same pace there, a lot of times that's just a lot of index buying. Could be rebalancing, although that we're kind of past all that. So that's probably not very smart to say that. Anyway, so that's what you have there. Let's take a look at industrials, down 1.2% on the day. Today is going to be your airlines. Mr. Buffett sold off all of his airline positions. He had American Airlines down 7% on the day. That's all because of him. United Airlines down 5% on the day. That's because of him. Delta Airlines down 6.5%. That's, guess what? It's because of him too. And you can probably guess. Southwest Airlines was one of his holdings. Made new 52-week lows, by the way, losing 5.1%. 5.7% on the day. That's all going to be because of Mr. Warren Buffett's comments there. And industrials lower on the day because those stocks are included in that sector. All right, the price of oil, another good day for oil. I love it. Up 7% on the day, getting back above the 20-period moving average. That's a string of good days in a row. That's going to be 5 straight days in a row for oil. And looking strong. You expect it to take a break in here somewhere. However, remember, OPEC is cutting. You got a lot of stuff going on in oil. You got the economy opening back up again. And you actually had an analyst, where was he from? Analyst, I like to give those guys credit too. Well, there was an analyst out there who basically said he thinks that there's going to be a serious surge in demand for oil or for gasoline. There he is. The analyst, I didn't put his name there. Says he's going to see a more intense gasoline demand going forward, and that oil is already starting to price that in. So you have the price of oil higher on the day. Any of the ETFs that you may follow also higher on the day. The Oil Explorers, XOP, had a great day. Energy itself, the XLE, back above the 50-day moving average. The USO, which it's not really what it used to be, but a great day for that one, actually. 4% on the day, so looking good there. And that's basically your sector overview for the day. Transports were the weakest sector out of the group. Can you guess? Not sector, weakest industry out of the group. Can you guess what stocks did that? Let's talk about some stocks here. You got Apple higher by 1.4% today. Here's an interesting thing. Apple is actually raising money by offering bonds, and they're just replacing old debt with new debt that's cheaper debt. Simple as that. Apple is following the recommended, like how I approach things, and just says borrow money when you can, not when you have to. There's a lot of companies out there borrowing money because they have to right now, paying extremely higher rates. If you're an individual and you borrow money because all of a sudden you're stuck and you have to, you're going to pay a higher rate. Apple's paying basically on average 1% over the current treasury rate, which is essentially free. They're paying next to nothing for all this debt. They don't need the money, by the way. They're just being smart and replacing old debt with new debt that happens to be cheaper debt. You know who's not borrowing money cheaply? Well, Starbucks. They're going to be trying to raise money. Avis, which didn't they tell us they may be going bankrupt? Avis trying to raise $400 million. You could bet it's going to cost them a lot of money. One Oak's kind of like a midstream oil company here, up 4.5% on the day. They're going to be raising money. And Kraft Heinz also going to be raising money. They were down just a little bit. And it's good performance for them a lot lately, but they're going to be raising money as well. So it's going to be another record week, it looks like, for these bond offerings. We'll see what happens. And lastly, I'll put in Phillips 66. If you saw our video last week or early the week before, we were talking about these oil companies, which ones have a lot of storage, could make some money out of that. Well, an analyst happens to agree with me. Said basically the same things we said in the video last week or whenever it was, but he said it today. And so maybe he was watching and he was like, hey, that's a good idea. Let's look at those stocks. And he's also the one that said, look, gasoline demand is just going to be through the roof as we go forward. You got low prices, people going back to work, will eventually start going back on vacation, OPEC cutting oil prices, basically everything we covered in the video for you here at Jazz. Oh, by the way, Constellation Brands, I think we covered this last week. Stock was up by about 2% today. They raised their stake. They had to raise their stake in Canopy Growth. It's not that they wanted to probably, but they had warrants that were going to expire if they didn't exercise them. They exercised them. They now own 38.6% of ticker symbol CGC. That stock was a little bit higher as well. Yeah, so that's what we got there. Earnings-wise, you got Tyson down a little bit on the day, about 8%. It was a bad miss for them on earnings. They missed by 35 cents on weaker revenues. After hours here, you got earnings from AIG. AIG, I believe, is still down, not much, less than 1% lower on the day. AIG, it says that they're currently paying out more than they're bringing in. It's not good for an insurance company, right? So AIG is in the business of calculating odds of how many people are going to need money and when they're going to need it. And right now it's not going well. They're paying out more. They said it won't affect them in the long term, and they did keep their dividend as well. So just temporary, a little hit for them. Which, by the way, if you've got your dough straight, you know you go with the highest deductible, right? Got it? The insurance companies are actually telling you the odds that you're going to get in trouble. And if you have enough money to pay the deductible, if the odds of you getting in any trouble, you know what I mean, a car accident, let's take, for example. If you know the odds, then why would you pay them more money for a lower deductible if the odds are in their favor, not your favor? Got to get your dough straight. Let's talk about a couple. Oh, I did it.
Hey, wait.
Always
Before
do this.
you go watch one of our...
It's Monday. So, one other one after hours that caught my attention, I believe is the best performer after hours. It is the best performer after hours. Up $7. Chegg. If you're familiar with Chegg, it is up to $51. That's going to be off my screen here. That's way up here at new highs. Chegg reported earnings, killed it. Raised their guidance as well. Remember, most companies aren't giving guidance. These guys raised their guidance, so looking good there for Chegg. And they beat on earnings as well. A lot of people doing more online education, as many of you probably know if you've had to stay home helping your kids through school. So that's the case for that. All right, a couple more things, and then I'll take your questions if you happen to have any, and we'll call it a day. Busy day for earnings. Check out our Outside the Virus show that we posted on our YouTube channel at, I believe, 3 o'clock today, where I actually took every single stock that's reporting earnings, not all of them, but the bigger ones that are reporting earnings, gave you the beat rates and all the stats and everything for those stocks in case you have them or want to know what's likely to happen. But tomorrow, we've got Alaska Airlines, Illinois Tool Works, Leidos, Newmont, Royal Caribbean, Regeneron Pharmaceuticals, Wayfair, all reporting in the morning. Wayfair is expected to lose $2.60. Alaska Airlines expected to lose $1.14. And then after hours, you got Activision, Blizzard, Disney. We'll see what happens there. EA Sports and Occidental Petroleum reporting. I will try to answer some of your questions, and if you don't have any, then we'll just wrap it up. There you go. Not a bad start to the week in terms of seeing a little bit of a recovery there. What do we got? What are your thoughts on DIV? You mean the ETF? Is that what you're asking? I'm guessing you're not saying dividends. I think you're talking about this one here. No real thoughts on it. I don't really. I mean, we could look at it real quick, but I would be curious about the volume. It's not bad. A couple 100,000 shares a day on average volume. You got to look at some of those. That's not going to be a big deal, but some of them they're going to be a bit of an issue there. $2 it's paying out in terms of a dividend. That's pretty good. That's really good. Slower mover tends to underperform now. So you're asking if you're in that camp where you're saying I need some kind of income. See, it had some issues there with being halted. That was a month ago. Yeah, that was during the decline there. Yeah. That's a slower mover. See how it's only recovered a little bit of the market's decline there? It's not going to recover all of it when the markets do. Or if the markets do. So just know that. You're sort of sacrificing a decent amount of growth for the dividend. Quite a bit, actually. Yep. You like Boeing there? Not really doing much. Yeah, lost 1% today, just staying near lows. I like that they got their own financing, though. I like that. Yep. That's pretty cool. Went to the government. Government gave them a hard time. They're like, we'll go get our own money. Forget it. Jeez. Speaking of money, we'll cover this tomorrow on Outside the Virus. California can't afford to pay unemployment. Not good. That's not good. You like the JP Morgan versus American Express? That's an interesting combination there. I'm not sure. Help me with that a little bit. Both of them are underperforming. Financials in general underperforming. So you're kind of picking an underperforming area there. Makes you feel like you kind of want to wait for a pullback. I hope it doesn't happen in the next 2 weeks on JP Morgan, but if you could get just a little pullback, that'd be cool. Yep. There was no $50 billion loss. That would only be if all stocks were sold at the end of the quarter. Yeah, that's the tough part with Warren Buffett. I know people like to give him a hard time when there is a loss. And he loses. Everybody loses. Fine. But you never really know the average cost, right? So you have to kind of guesstimate where he sold the positions as far as having that price there. Yeah, that's a good point. Yeah. You got tomorrow. I don't know. The question is tomorrow red or green? Well, turnaround Tuesday, right? I know we've been having some fun with the turnaround Tuesday, so you'd have to say to the downside there, but let's see. You got a 42% chance that 42.9% chance that tomorrow will be positive, at least as of the data for the whole year so far. Yeah. George says, is Warren Buffett panic selling? I wouldn't call it panic selling, but I did kind of find it interesting that there were a lot of comments. The first 75 minutes of the whole show was about how investors should be optimistic for the long term. I buy that. But then he spent all that time saying how he's putting money in cash and that he found nothing good to invest in. Right? That's a tough one. That's a tough one. You had a good day, 2.64%. I mean, you do that every day. If you could do that every day, you know? All right, I have done my thing here. Let me see. Did I cover everything I wanted to cover? Constellation Brands. Oh, Ferrari beat on earnings. You know Ferrari? Anybody got a Ferrari? They lowered their guidance, though, but that's what you got there. What do you think is going to happen to REITs in the future? Do you think office will continue as it is? Well, if you're talking about office space REITs, right, you got to question the success of those versus the other ones, right? So REITs in general, I know a lot of people like to think, oh, it's like apartments and offices. There's a whole mix there, especially if you're playing in the REIT ETFs out there. You're not investing in what you think you're investing in. So just make sure that when you pick a real estate ETF that you understand what they're focused on. There are some of them that only focus on IT real estate. Meaning like server space, things like that. There are some that focus more on storage spaces and things like that. So careful if you're choosing ETFs, but for the office space REITs, you got to imagine, and especially seeing with what Cheesecake Factory's done and limited brands and people holding off on paying their rents, it's a slightly different category, but you get what I'm saying. Oh yeah. You can't see my chart. I don't have them up. I'm not pointing at anything. You got to look at this. All right, well, you're done looking at this. I will wrap it up there for the day. And yeah, we'll be back tomorrow and do this all over again. Thanks so much for watching and enjoy. See you later.
Hey, wait! Before you go watch one of our other great videos, have you had a chance to see our new Fin Tips videos? They focus on one topic at a time, covering investing, personal finance, and anything that can quickly help you with your dough. Best of all, we'll keep it real short, because we know time is money.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.